Hello, I'm Robert and welcome to my channel, where I discuss everything automated algorithmic trading, or simply algo trading. Today I'm going to take a real look at my multi-layered strategy approach and break down exactly what it means in a real trading environment. And I'm going to do this with my live money account. Now, this is not an account that has a lot of money in it, but it doesn't matter because the principles are always the same. Let's start with the equity curve of the account currently, where you can see where I started the account with a zero balance profit, and then over time it grew. Now you can see where I started adding layers, and those layers started to build on top of each other. For example, back here, up until about the early portion of May, I was just using the 17, 47, 197 momentum SMA combination. That was it, one simple layer using 0.01% of my balance per position size. But then as I started adding layers, to which I documented in my Patreon, so if you want to see those, please be sure to subscribe if you're not. You can see exactly how it cascaded and how each part plays on the previous as part of my profitability. Now, in every single one of these layers, my take profit is 10 pips and my stop loss is 405 pips. As I discussed in a previous video, using this upside down reward to risk ratio has proven very beneficial because I am using statistics and probability in my own trading to give me that edge of being more likely to hit a profit versus a loss. Now, of course, one loss can be devastating, which is why the layers need to be calculated so carefully. We're going to go over the charts in a little bit with some detail to it, but each component of this system works together to build that multi-layered approach, to build that consistency from the tiniest profits to the more astute and larger profits. By leveraging risk and reward in such a unique way and using the combination of multiple layers that may or may not be correlated, you are able to build a framework and a context that lets you trade in a way that provides a consistency to the overall effect. So now that we see the equity, and this is real money, let's take a look at the trades. As this loads, we can see, much like my grid trading technique, the multi-positional format is basically just another form of a grid. By using an unbounded technique, meaning you're not reliant on step sizes or distance between positions, but rather an indicator-based approach, you can capitalize on and take advantage of unique market conditions. For example, in looking at the trades, we can clearly see where volatility took place, like this wall of sell-offs or these gaps where price jumped up quickly. By having this kind of a unique dynamic in your trading, and by having a real consensus of what your risk is, you're able to build and layer on a consistency that proves very resilient to unusual market conditions. By having an aggressiveness versus an defensiveness within the same strategy and taking a positional approach, you're able to spread your resources out over time and more efficiently to weather the market on a consistent basis. So let's go and take a brief look at the charts themselves. The first chart, which is what I started with, shows basically the moving averages, support and resistance, my range filter, and finally a stochastic. And of course you can see here my actual live money alerts, where I go through each of the components layer by layer, looking at what those components represent in terms of my risks. That really is the entirety of the whole process, understanding risk. So as we scroll through this chart, and you see the various signals that exist, in every case for this pair, I am shorting only. Each signal with a different color corresponds to a different level of percentage that I am using within my budget. So as we look at the actual indicators, the indicator I started with, the moving averages, this is the least amount of risk and the most aggressive in its purchases, as we can see from the cyan or teal colored signal points. This aggressiveness allows me to capture unusual market conditions and yet mitigate risk, because I am allowing the system to use only a fraction. But because of the compounding, every single winning trade adds a little bit more to my balance. So every new entry is a slightly larger amount of the percentage of my balance. So this cascading effect is what allowed the entirety of the balance to grow over time in a consistent way when I first started out. For example, we can see with these two, and then seeing this big drop, demonstrating clearly that both of these two positions sold off in profit. So by looking at the smaller, tinier amounts of profit, and by being able to aggregate these profits in such a way that the account is always bringing pennies in, the compounding of this particular approach is in of itself a rewarding aspect of the entire paradigm. And we can continue going back further and further throughout the history, and we can see how this compounding effect really does begin to add up over time. So this is the 0.01% approach. So now let's look at the next approach, the 0.1% approach. 0.1% of my budget goes into this particular approach. And as you can see, this is a support and resistance approach that is combined with the previous layer of the moving averages. So by combining those two layers in this particular strategy, I am able to eliminate a lot of the unwanted trades and therefore increase my position size more efficiently. But because these trades don't occur as often, I don't receive as many benefits as I do with the more hyper-aggressive approach and the more rapid amount of trades coming in. Compounding with this approach is slower, even though I am using a slightly larger position size. And that really is the whole point. As you move up in position value and position weight, you want less and less trades because you want your budget to be spread out more evenly and risk-centric. So we continue to see just how easy this system begins to coalesce together into one single trading paradigm. So now let's look at the range filter approach, which builds on top of this. The range filter is even less trades, and less trades means higher percentage of budget. You can see here where the risks are greatly reduced compared to the other two layers. So it supports a higher sustainable position size in relation to the totality of the budget. As each layer builds on top of the previous, whether directly correlated as this particular one is by combining with the moving averages, or a completely separate strategy that we will look at shortly, we can begin to see just how well and unique this whole system works. And that really is the point of the practice. The combination, the intricacies of the layering, the interplay between each of the layers as they build on one single methodology and ideology, one concept broken down into individual fragments. So now let's look at the 2% position sizes, which is the stochastic. And we can see clearly that there's hardly no trades at all. But this is 2% of the budget. And the likelihood of that happening isn't as great, which is appropriate. We have the first buy signal, but because we are shorting, we are only interested in sell signals. And this is literally 2% of the totality of the budget. So in that, in understanding the amount of risk that a single position takes and the severity of that risk in the combination, we clearly see within it a potential of how much profitability can be made, and yet how long it takes for this one single indicator to provide a single signal. The relationship of this in the entirety of all of the trading approach itself is that it doesn't happen often. So because of that, it's not going to be as profitable compared to the more aggressive approaches. But in its lack of profit compared to trading value or trading volume, a single position has the ability to nonetheless bring in a very generous profit when it does occur. And as we continue, we can see, finally, we find a sell signal. And it's a signal that clearly shows the difficulty of this kind of process. Because when we look at the chart, it's not an opportunistic area to buy into. That is, after the signal, the market goes up quite a bit. And it's not for a while that the market drops. In fact, it keeps going up. And that's fine because that's what the layering is about. So this particular position is a nasty little risk. And that nasty little risk has a severe complication that does indeed cause problems. This position is going to be held for a while. That means it's using margin, and it has a net asset value that is going to erode the totality of my budget in relation to my margin. So the lower, more aggressive position sizes are going to help offset and mitigate the risk of this one single position taking 2% of my budget. So this is about the 6610 range. Let's see how long this gets held. May 24th. We can see the market climbing. We can see the market is still drastically above the entry point. Roughly 50 pips above the entry point. And finally, around this area, it drops below the 6610 range and sells off at a profit. Since I'm only interested in 10 pips, it gets out of it. But we can see clearly just how long the position held. And that really is the point of the layers. The more surgical an entry point is, the more likely you are going to have to hold it to reach your profits. The more likely you're going to need breathing room for your stop loss to prevent you from getting stopped out. And that really is the critical point of this kind of process. You need to have those layers to protect and mitigate against risks of a single position, of a single entry. So now we see the first 4 layers as they are listed here. Let's look at the 5th layer, the 3% trailing size. And we can see here that it is the same way. The position sizes may not always be opportunistic, but because of the totality of all of the layers working together, they help offset and show that the market is going to be profitable in the interim of the trading process and approach. So we can see here that most of the positions are going to be opportunistic. Like this one pretty much sold off very quickly, within a few hours, whereas the last one is still being held. And that is really a combination of the market, the nature of the market, and the amount of risk you can take on. The thing about this approach that is really important is that the layering connects in such a way that it just works together. But it doesn't come easy. For example, we see another situation of an entry that is far from opportunistic. And this particular approach isn't related to the previous 4. That is, the strategy used here on the 3% is completely different and unrelated to the previous charts where 4 layers worked together in harmony. And that really is the second part of the process for a multi-layered positional approach. You don't have to use the same strategy when you're looking at your trading in a positional context. You can actually combine completely unrelated strategies and see how they work together to build a crescendo of opportunities. So even as you look at the various components that are used within the trading, where you see the black markers are actually what are the deciding factors of trading, you can see how everything fits together, connects, and interweaves into a single ideology, a single connective result. And this particular one, using a rune, is an interesting approach that offers an opportunity that doesn't really seem obvious, and yet it does exceptionally well. And that really is one of the biggest advantages to a multi-positional approach, to be able to layer uncommon and unusual indicators in such a way that you'll be able to get a combination and a resultant. So a rune and momentum combined with a trailing approach can produce some wonderful results. And it's an amazing, generous, profitable situation, though this one doesn't occur very often at all. In fact, even less than the stochastic. So as position sizes are reflected appropriate to how they connect together in the overall thinking process. Period. So as we move into the layers and we move through the layers, when you're building your approach, always start with the hyper-aggressive, the layering that is going to bring you the most trades at the smallest amounts of profit. You want a functional layering that has pennies rolling into your account at a constant basis. That compounding is really a critical component of the entire process as you build on this thinking approach, as you build on this paradigm. From there, you want to move to an aggressive approach, and then what might be considered a neutral approach. Then you want a defensive approach, and finally, a hyper-defensive approach. Now, I chose 5 layers, and I may end up adding more over time that interweave in between these layers for a particular effect and approach with my budget. But really, you don't need 5 layers. It could be 2 layers, it could be 3 layers. The ideal here isn't to overload or oversaturate your trading, but to consider each component of the trading in such a way that you have a consistency, not just in the short term, but the long term. And that is the critical focal point of the entire process. And that focal point is what leads to the profitability that can cascade over time. You start out slow, build on your most aggressive, smallest position sizes, and then you cascade up slowly and meticulously, carefully analyzing every detail and watching how the metrics play together, watching how the components fit together to build the bigger picture. And from there, you see just how all of the components interact, and you make changes in such a way that you never let your account get out of control. Whether it's lowering the position sizes or removing a layer completely because it might not fit the overall theme of what you're trying to accomplish. The importance here is that you have a hands-on approach, constantly monitoring, watching, and considering all of your options. For example, right now, this particular approach has 58 open positions of a wide range of different position sizes. That paradigm allows me a very wide latitude in keeping my risk controlled, because at any given moment I can turn off one layer and focus more on the smaller layers or larger layers depending upon where I am sitting in relation to both my margin and my net asset value. That is, I can keep control of my account easily by simply being able to look at a single layer versus the entirety of the entire paradigm. So hopefully this will help in seeing and realizing just how powerful this approach is, and that the best trading often relies on unconventional thinking, whether it's an upside down risk to reward as I am using, or just looking at the market in a different viewpoint. Test, evaluate, and think about the long-term strategy in relation to your short-term gains. If you like this video, please give it a thumbs up. Please share it for somebody that might be struggling with their trading and help them gain an appreciation to where taking less risk can be more profitable in the long run by looking at a whole different context and understanding that a market might have. If you're not subscribed, please subscribe. And if you want to see how these different paradigms actually look through the indicators, be sure to subscribe to my Patreon. The link will be in the description. Thank you for watching, and until next time.